And let me start by taking the opportunity to extend a formal welcome to the Governor and staff of the Central Bank to Tobago. And while I do that, I must thank the bank sincerely for deciding to launch this edition of the Monetary Policy Report here in Tobago. And this is particularly historic in that it represents the first time since the start of the publication about a decade ago that the report is being launched in Tobago, and we must applaud the Central Bank for that. I wish to commend the bank for seeing the wisdom of moving the launch of the report away from the traditional location in Port of Spain and bringing it closer to Tobago, to the people whose livelihood can be affected by some of the initiatives contained therein. One fundamental benefit of hosting this launch in areas outside of Port of Spain is that it could serve to increase the general interest and awareness of a greater number of persons on issues of economic policy and encourage many more persons to pay closer attention to how they can be affected by the bank's policy actions. And of course, it demystifies the bank and it personalizes, and we recognize that there are not some people in this hallowed place doing strange things that we only know about when it affects us adversely. So I think this is an excellent initiative. And that is why we are truly delighted to have the launch of this report, which seeks to provide an account of the bank's monetary policy and the impact of those actions on economic agents here in Tobago and of course the rest of the country. Notwithstanding the fact that the Assembly has no direct responsibility for monetary policy, we know that monetary policy actions undertaken by the Central Bank can and do impact us here in Tobago. We are very aware that the Tobago economy is inextricably linked to that of Trinidad. The implications of this are that actions by decision makers and economic agents in Trinidad and in many instances have a significant impact on our quality of life here in Tobago. The fact was clearly borne out by the recent events in the foreign exchange market. And although the members of the Tobago business community are maybe sometimes not as vociferous as their counterparts in Trinidad with regard to the problem of shortage of foreign exchange, we know that businesses in Tobago have been adversely affected by the shortages experienced in the foreign exchange market. We therefore welcome the recent news that the bank has agreed to inject a further $200 million US into the foreign exchange market to help to address the situation. And we'll be monitoring the effectiveness of that measure. And I'm certain we'll get some feedback from Mr. James and his people. The link between the Tobago economy and that of Trinidad is even more evident when one looks at the issue of inflation. We know that most of the inputs into production occurring in Tobago are imported from Trinidad, and we have to do something about that. And elsewhere, resulting in Trinidad having a high imported raw material content in production. The implication of this is that it increases increases in the cost of raw materials outside of Tobago are passed on to consumers in Tobago, thereby presenting problems of imported inflation for us here in Tobago. Indeed, some of the food price inflation that we experience here in Tobago is directly influenced and fueled by price movements in Trinidad and the rest of the world. This means that policy interventions that influence prices outside of Tobago can and do influence price movements here in Tobago. This suggests that monetary policy actions by the central bank, which could influence price movements, can and do have significant implications for Tobagonians. And that is another reason why this launch of this edition of the Monetary Policy Report is of particular significance. And ladies and gentlemen, beyond its effect on inflation, monetary policy also influences the general level of economic activity through its effect on interest rates, investment, and ultimately output and employment. This nexus between monetary policy and the real economy is of particular interest to us here in Tobago in view of our ongoing efforts to diversify the Tobago economy and develop an indigenous business class here on the island. Indeed, inappropriate monetary policy interventions could push up interest rates, jeopardize investment options, and affect the level of growth and employment. And the Secretary of Finance, who had a very important engagement in less than a month, the business community and other sectors will obviously be particularly interested in the content of this report. As an assembly, Mr. Governor, we are particularly heartened by the collaboration we have been able to forge with the Central Bank. Over the past few years, we know that there has been a close working relationship between our Financial Literacy Secretariat in the Division of Finance and Enterprise Development and the bank's National Financial Literacy Program with regard to financial education. In addition, there has also been collaboration between the bank and the Division of Finance and Enterprise Development through a memorandum of understanding to have the services of the Financial Services Ombudsman available in Tobago. And I'm happy to recognize that you're no longer renting, you're no longer squatting, you're here, and that's nice. Moreover, coming out of a meeting earlier this year with the bank, we're already seeing some fruits. In this context, let me extend sincere thanks to the bank for agreeing to offer 2 guaranteed slots for Tobagonians pursuing tertiary studies in areas related to the bank's operation and to participate in the bank's vacation internship program. We believe that this will no doubt provide them with some meaningful work experience and serve them in good stead in their chosen career paths. We also wish to thank the bank for providing us with the data on the financial sector in Tobago for the period 2010 to 2013, which we are using to estimate the real gross domestic product for Tobago for the past 3 years. This will allow us for the first time to be able to derive estimates of the economic contribution of the financial sector to the Tobago economy and to get a more precise understanding of the health of the Tobago economy. We as an administration fully understand and embrace the value of having reliable economic and social statistics on a timely fashion to inform economic policy formulation and economic planning. We know that policy cannot reasonably be properly shaped without the requisite data. An issue which concerns us here in Tobago, therefore, is the fact that data are seldom provided separately for Tobago on some of the major macroeconomic indicators. We wish to encourage the bank that as far as possible in your statistical report, that you consider providing us with Tobago-specific data on some of the major macroeconomic indicators. We as an assembly are also actively engaged in improving our own capacity to generate Tobago-specific data to augment the limited data we currently receive from the Central Statistical Office in Tobago. Looking ahead, I wish to urge the Central Bank to continue to collaborate with us as we seek to develop our island and improve the quality of life of our people. In this regard, initiatives such as this current one that seek to increase the awareness of the role and function of the Assembly and how the monetary policy impacts us are very much appreciated. We also encourage the bank to continue to collaborate with us in areas of financial literacy and financial education. We recognize that it is only through financial education that we can increase the capacity of residents to make wise spending decisions and manage their finances, and of course provide them with the basic understanding of financial products and services that will enable them to function confidently in an increasingly sophisticated financial environment. In addition, we wish to encourage greater collaboration between the research department of the Central Bank and our research units in the THA with regard to research of specific relevance to Tobago. Maybe you could consider, where appropriate, inviting some of our research staff to your research seminars and training courses which can be beneficial to the Assembly and Tobago. On behalf, Governor, ladies and gentlemen, of the people of Tobago, let me again thank the Governor of the Central Bank for launching this edition of the Monetary Policy Report here in Tobago. Although we as an Assembly do not have any direct influence over monetary policy, we know that monetary policy, and I reiterate, does have significant implication for us here in Tobago. We ask, therefore, that you continue to work with us, and based on our interaction in the recent past, I have no problem with believing, in fact, being very convinced that you will continue to work with us and that you will continue as you have done to walk the talk. And we ask that you continue to further enlighten our citizenry, both inside and outside this room, on the role and responsibilities of the bank and how the bank's actions impact them.
Good morning. Today is certainly an historic day for the Central Bank and for the people of Tobago. As Mr. London has rightly indicated, for just the second time in its 50-year history, the bank has ventured out of its traditional comfort zone in Port of Spain to deliver its monetary policy message. Events such as this Monetary Policy Forum give the bank a platform to explain its thinking behind its monetary policy actions, and it gives us the opportunity to interact with stakeholders. And as far as central banking regulations allow, it gives us the opportunity to account to the national community, who we are here to serve. I must therefore thank the Tobago House of Assembly and Chief Secretary Orville London for graciously agreeing to host this, our second Monetary Policy Forum. For us, Tobago was an almost obvious choice, given the diversification trust in which tourism is being called to play an increasingly important role. In the IMF's Article 4 consultation report for 2011, Tobago was reported as being considered as having significant potential for sustained growth in tourism, owing to its conventional beach resort type properties and ecotourism. We are, however, aware that there are some challenges that are being confronted surrounding the growth and development of the tourism sector here on the island. In particular, we are quite aware of the challenges relating to the Tobago Tourism Development Fund for stimulating new investment in hotel properties. And I give you the assurance that the Central Bank is actually working very closely with the banks involved and with the Ministry of Finance on finding a viable solution in terms of moving forward. And I think we are very close to finding that solution in the coming weeks. Ladies and gentlemen, I do not need to remind anyone in this room that we are living in unusual times. I will start off this monetary policy report by placing Trinidad and Tobago's economy in relation to economic developments in the world economy. Central banks and other policymakers around the world have been grappling for more than 5 years with an economic crisis that is constantly mutating, and it is still not clear how that crisis is going to evolve from here. Although global financial tensions have eased, we are heading into mid-2014 with a world economy that looks like it will be stuck in a subdued growth phase. Economic performance in the United States was weaker than expected in the first quarter of 2014, even though it outpaced that of Europe and Japan, both of which are struggling to cross a moderate 1% annualized growth threshold. Economic growth is also slowing in the larger emerging market economies. China, the second largest economy, is slowing below the government's growth target, and this is likely to lead to a drag on the global recovery. Given credence to the trend and metaphor, when China sneezes, the rest of the world catches a cold. Of course, that used to be said of the United States. It actually reflects the change in power dynamics in today's global economy. The Russia-Ukraine conflict, which started early this year, has added a new dimension to the uncertainty to global economic prospects. Although to date, contagion effects have been limited to those countries with direct trade and financial links to the Eastern European region. For Trinidad and Tobago, this conflict represents a double-edged sword. On one side, any escalations in tensions between Russia and Ukraine could result in higher crude oil prices, which would certainly benefit Trinidad and Tobago. On the other side, both Russia and Ukraine are significant wheat producers, and therefore an escalation in conflict could see wheat prices rise, which will translate into higher food prices here in Trinidad and Tobago. The change in monetary policy stance in major advanced economies remains a key focus of global financial markets. Of the major central banks, only the United States Federal Reserve, with its new chairman, Janet Yellen, has actually started the process of scaling back its unconventional monetary policy that has been in place for the past 5 years. This highly anticipated tapering only takes into account conditions prevailing in the United States. In other words, emerging market economies like Trinidad and Tobago are left to fend for themselves and to navigate the spillovers and policy mistakes that could arise from US monetary tapering. Only 1 year ago, the Fed's announcement that there would be an earlier than expected start to the reduction of quantitative easing rattled several large emerging market economies. This resulted in capital outflows, depreciating currencies, and it tumbled their stock and bond markets. So, given the global prospects, I wanted to talk to you about 3 things. First, outline some key developments in Trinidad and Tobago's economy over the last 6 months. Second, explain the monetary policy actions of the central bank in the context of the evolving domestic and international conditions. And third, conclude with some thoughts on the short-term economic outlook for Trinidad and Tobago. Ladies and gentlemen, I'll begin with a brief overview of domestic economic conditions since the release of our last monetary policy report in November 2013. Here the news continues to be encouraging. Trinidad and Tobago is in recovery mode. After a few years of subpar performance, Trinidad and Tobago's economy delivered faster than expected growth of almost 2% in 2013. The ongoing large-scale maintenance and safety upgrades at energy companies posed a considerable drag on our recovery throughout last year. This impact was concentrated in the third quarter when the largest coordinated maintenance turnaround occurred. Activity in the non-energy sector, though slow but steady, provided critical support which kept the economy from veering off track. This performance continued into the first 3 months of 2014, although the rebound in the energy sector in the fourth quarter of last year did not fully carry over into the early part of 2014. 2 events temporarily affected energy production in the first 2 months of this year. BPTT took down its Savannah platform to accommodate drilling at another well, and Petrotrin undertook planned maintenance at its Pointe-à-Pierre oil refinery. However, energy output bounced back by March of this year. Meanwhile, the non-energy sector maintained its growth momentum into 2014. Local sales of cement, a key indicator of construction activity, showed a favorable outturn. The increase in construction activity reflected several large ongoing projects in the public sector, including the highway to Point Fortin, and perhaps to a lesser extent, some private sector projects breaking ground, such as the C3 Movie and Shopping Complex in current South Trinidad. New car sales are still hitting double-digit rates, and higher crop production under the Caroni Green Initiative is supporting growth in the agricultural sector. A key mandate of the central bank, as you are quite aware, is price stability, which roughly translates into keeping underlying inflationary pressures well contained. Inflationary pressures have remained subdued so far in 2014. Headline inflation for Trinidad and Tobago slowed to just under 3.5% by April 2014. This ease in inflation was largely associated with a steady fall in food price inflation to single-digit territory. I'm also aware that since March of last year, there has been a rise in differential between inflation rates in Trinidad and that in Tobago. And as Mr. London has indicated, it does pose some considerable concern, and I will be asking my research department to actually perform a value chain analysis to determine what are the factors accounting for this differential. And this differential now amounts to about 400 basis points as at April of this year. The fall in food prices that we've seen reflect improved domestic agricultural output, better domestic weather conditions, and an easing of global food prices. Meanwhile, core inflation, which exclude food prices, picked up slightly to around 2.5%, but remained stable in the first 4 months of 2014. This slight pickup in core inflation actually reflects the improvement in economic activity that we've been observing. We are also starting to see a pickup in business lending. After contracting for an entire year, business loans granted by the banking system rose by a little over 2% in February this year and further increased to almost 3.5% in March. We've also seen relatively robust growth in consumer lending, especially for purchases of motor vehicles, home renovation, and debt consolidation. Record low mortgage rates continue to spur demand for real estate mortgage financing. Although such loans continue to register double-digit growth to March of this year, and there has been an increase in property prices, there is no compelling evidence to suggest overheating in the residential property market. More importantly, commercial banks continue to maintain their prudent mortgage lending standards. Over the past years, the government's budget has been the main stimulus to supporting economic recovery. The non-energy budget deficit, which is a key indicator of whether government is engaged in fiscal stimulus activity, ran at around 19 billion in fiscal 2012-2013. For the first 6 months of fiscal 2013-2014, the government has run a non-energy budget deficit of about $12 billion. At this pace, the government is likely to meet its projected budget stimulus for the entire fiscal year, providing further support to the economic recovery underway. Ladies and gentlemen, I now turn to a matter grabbing headlines and generating intense interest in the country over the past few months. And the reason I suspect most reporters are here this morning to grill me about foreign exchange. There have been many opinions circulating on this topic, and I will say in most cases, these opinions are uninformed. The foreign exchange matter came to a head last week when this sensitive issue entered the political domain with comments made by those who displayed little knowledge and understanding about the central bank's role in the domestic foreign exchange market. So, please allow me to say a few words about the central bank's actual role in the domestic foreign exchange market. First, the bank seeks to foster orderly conditions in the market, mainly by meeting the gap between the demand for and the supply of foreign exchange. This gap arises because the general public and the business community usually consume more foreign exchange than is generated by companies in the energy sector, which are our main suppliers of foreign exchange. Demand for foreign exchange is continuous throughout the year, but the supplies come in at discrete intervals. This leads to periodic tightness in the domestic foreign exchange market, which the central bank alleviates by selling foreign exchange from its stock of official reserves to the banks. Second, until April 2014, the central bank was using a 20-year-old system to sell and distribute foreign exchange to the banks. As an aside, I was part of the team at the central bank that instituted this distribution system following liberalization of the foreign exchange market in April of 1993. This system served the market well, particularly in the early years. Over the past 20-odd years, however, there was little, if any, modification to this arrangement, even though the economy experienced various episodes of stabilization, growth, its third energy boom, stagnation, and now recovery that fundamentally altered the foreign exchange demand-supply equation. Over the last 2 decades, demand for foreign exchange not only expanded, but its composition changed to reflect new patterns of consumer spending. For example, the use of credit cards to make online payments. And demand also reflected new forms of investment. With no capital account restrictions, citizens can move money freely to any part of the world. In 1993, the demand for foreign exchange amounted to US $900 million. 10 years later, this demand almost tripled to US $2.6 billion in 2003. By 2013, demand had risen by more than 2.5 times to US $7 billion. At the same time, the supply of foreign exchange increased, but was outstripped by demand. In 1993, supply of foreign exchange amounted to US $856 million. 10 years later, this would increase by almost 2.5 times to US $2 billion. In 2013, the supply of foreign exchange almost tripled to US $5.8 billion. This imbalance between demand and supply prompted the central bank to sell increasing volumes of foreign exchange to quell excess demand pressures over the last 20 years. In 1993, the central bank sold a mere $33 million. That is now a standard intervention today. This level of sales jumped to almost US $500 million by 2003. And last year, the central bank sold US $1.7 billion to the banking system. So with growing tightness in the domestic foreign exchange market since the start of the year, the central bank reviewed its 20-year-old arrangement for distributing foreign exchange to the financial system. Two fundamental changes were made, effective at the start of April 2014. First, we included all 12 licensed authorized dealers in the distribution system, providing everyone with greater access to more evenly distributed supply. Previously, only 8 authorized dealers were part of the arrangement. Second, we made more use of the auction system so that supply of foreign exchange could go to where demand was greatest based on price. After nearly 2 months of operating the new foreign exchange distribution system, we made further improvements to the system's internal back office operations, but we did not alter its fundamental parameters. This enhanced distribution, coupled with more timely and sizable interventions, is expected to meet all immediate trade-related demands, from the foreign used car dealers to manufacturing companies to small and medium businesses and to conglomerates. For the first 5 months of 2014, we sold US $610 million to the financial system, with the most recent being the sale of US $200 million that actually becomes effective today and is in the system. Let me make this clear. The new changes to the foreign exchange distribution system were not ineffective, but change is always difficult to accept, as many of you know. Foreign exchange management is a highly sensitive area of central banking. We are not at liberty to divulge the details of our operations. However, we have been regularly communicating as much as we are allowed to under the Central Bank Act on this matter. This central bank is not more secretive than any other, especially when it comes to foreign exchange operations. I am not being defensive, but irresponsible statements on central banking matters pose a real danger to our country. I therefore want to assure the national community that there is no risk of devaluation of our currency. And let me repeat, I want to assure the national community that there is no risk of devaluation of our currency. We have enough foreign exchange reserves to satisfy demand. As of mid-May 2014, the stock of foreign exchange reserves amounted to almost US $10.5 billion, more than enough to cover more than 1 year worth of imports. This is all I can and will say on this matter today. So let me turn to the central bank's monetary policy actions. And before I explain what we've done over the past 6 months, I'd like to reiterate some of the major changes that we made over the past year to the central bank's monetary policy decision-making framework. These changes are as follows. 1, inclusion of 2 external members on the bank's monetary policy committee to ensure that the committee benefits from specialized expertise and diverse viewpoints in its policy-making deliberations. 2, we reduce the frequency of the Monetary Policy Committee meeting from once a month to every 2 months, in order to give the committee a better opportunity to fully consider economic and financial conditions, including important issues and policy alternatives. And 3, we've communicated the bank's monetary policy decisions, including the setting of its repo rate, to the public in the form of a monetary policy announcement on the Friday evening of the week in which the MPC meeting is usually held. Our next monetary policy announcement will be released this Thursday. And at the same time, we will formally release our April 2014 monetary policy report. So both have actually converged during this period. I now turn to our monetary policy actions. Given the gradual pace of economic recovery and stability of core inflation, the central bank has continued to maintain an accommodative monetary stance. This is reflected in the fact that the bank has kept its main policy rate, the repo rate, at a historical low of 2.75% since September 2012. At the same time, our liquidity management capacity has been improved. In December 2013, when Parliament approved increased borrowing limits on Treasury securities for the purposes of open market operations, the limit under the Treasury Bills Act was doubled to $30 billion, and under the Treasury Notes Act was tripled to $15 billion. In other words, we now have an additional $25 billion in Treasury securities that we can issue to absorb excess liquidity in the banking system. And I want to emphasize that these Treasury securities are purely for the purposes of monetary policy, not fiscal policy. The proceeds of the securities are locked away in a blocked account at the central bank and do not re-enter the system until the existing securities mature. And I must again emphasize that these funds are not used to finance the government's budget or any government program. With elevated liquidity levels, the central bank began to increase its open market operations in April of this year, removing roughly $1.2 billion from the banking system. However, the maturity of a $1 billion central government bond at the end of April has pushed liquidity levels even higher. Subsequently, in the first 3 weeks of this month, excess liquidity has climbed to an average of $8.3 billion, from an average of $6.3 billion in April. The central bank also undertook other liquidity management measures over the past 6 months, including rolling over special deposits of commercial banks which matured during the period. The bank also indirectly removed liquidity from the system through its sales of foreign exchange. The central bank will continue to intensify its open market operations, as well as use other liquidity absorption measures to rein in excess liquidity in the coming months. I would now like to turn to the outlook for the rest of 2014. While we expect a strengthening of the global economy over the next few years, it is fairly evident that uncertainty continues to weigh heavily on short-term economic prospects. Perhaps the most immediate downside risk to emerging market economies, including Trinidad and Tobago, relates to shifting market expectations about the future path of U.S. monetary policy, as I mentioned earlier. Here at home, the first business confidence survey conducted by the Central Bank and Arthur Lockjaw Graduate School of Business found the local business community is cautiously optimistic about the prospects for business activity and the economy for the remainder of 2014. Several factors support the central bank's 2014 outlook. First, energy production returned to more normal levels in March 2014, providing a strong boost to the economic recovery now underway. Drilling in the shallow water blocks has commenced and some new development wells have already been drilled. Awards for onshore bid rounds will lead to increased exploration activity in these blocks in late 2014 or early 2015. Second, there has been an improvement in the pace of projects execution at the level of the central government. Ongoing large public sector projects include the Point Fortin Highway, the Children's Hospital, and the National Aquatic Center. These, combined with other projects undertaken by the private sector, are expected to further boost non-energy activity. At the same time, improving energy output should also have a positive impact on non-energy growth. Third, the central bank has begun to implement its resolution strategy for CLICO. This strategy always envisaged the sale of CLICO's traditional book of business to a third-party insurance company. As we undertake the sale and transfer of the portfolio, in accordance with legislative requirements, CLICO's traditional policyholders have nothing to worry about. They will continue to be serviced by CLICO. The long-standing CLICO issue, when successfully concluded, should give a further boost to overall confidence and reinforce the positive economic growth trend that is now underway. On this basis, the central bank expects real GDP growth to strengthen to at least 2.5% in 2014. Ladies and gentlemen, over the past few years, record low domestic interest rates have contributed to consumers borrowing more to finance spending on high-priced consumer durables, such as motor vehicles. Domestic interest rates have also fallen below or just above those in the United States, which means investors are more likely to be attracted to seeking higher investment returns in the United States, leading to capital outflows. Looking ahead, the strengthening of our economic recovery, rising consumption, and the threat of higher international agricultural food prices all suggest inflationary pressures could increase in the coming year. With a firmly established economic recovery, the central bank will start giving more weight in its monetary policy deliberations to managing rising inflationary expectations. This will initially start with a gradual withdrawal of our accommodative monetary policy stance, which has been in place for the past few years. Should the outlook for inflation, growth, or financial stability change, we will take appropriate monetary action. In conclusion, I wish to reiterate that Trinidad and Tobago has shown tremendous resilience. Yet, this is not the message that we continue to absorb as a nation. Instead, it usually tends to be one of negative sentiment. When I assumed office nearly 2 years ago, I faced the following economic conditions. 1, a sharp contraction in economic growth. 2, soaring food prices running at an annualized rate of around 25%. A declining external reserve position and weak business confidence. Today, economic recovery is established. The economy is expected to grow by at least 2.5% this year. Food price inflation is down to single digits, standing at 4%. The difficulties in the foreign exchange market will dissipate in the coming week. And business confidence is cautiously optimistic and should be bolstered by a successful conclusion to the CLICO resolution, which is underway. Therefore, it's not all doom and gloom. At the same time, we at the Central Bank are not complacent. We recognize the significant threats faced by emerging markets such as Trinidad and Tobago in the still uncertain global environment. We see the obstacles that are on our road to recovery. The Central Bank continues to monitor the economic landscape and will exercise our available monetary options. As business leaders and stakeholders, we encourage you to take your place and be the positive change you want to see in Trinidad and in Tobago. Mr. London, I continue to give you the assurance that the Central Bank will further deepen its collaboration with the THA in pursuit of our economic and financial stability mandate, which is to serve the people of Trinidad and Tobago.